private lending is up 35% year over year right now. And as you guys all know, that's, the bank's boxes are getting tighter and smaller. And, it's not easy to go to, when rates are at 6 and 7%, to qualify at 8 and 9% for a mortgage at the bank.
You're listening to the Ottawa Real Estate Podcast with your hosts, Paul Stevenson, David Warren, and Greg Campbell. Let's see what's going on in the world of real estate today.
All right, we're back. Well done, Greg. This is the Ottawa Real Estate Podcast, and my name is Paul Stevenson. I'm joined as always by Gregory Campbell and Mr. David P. Warren. I know it's not P, but it sounded like the right initial. Sounded very educated. We have a guest today who we'll bring in shortly, Darren Campbell. For anyone who's in, at least on the mortgage side of the industry, I'm sure you've met DC over the years, and we'll let him introduce himself when he comes in. Gentlemen, how was the weekend? How are we doing? How's Monday?
Monday's actually pretty nice for me. The weekend was interesting. I spent a lot of family time. My wife just flew off to Anna, who does the intro on our show. She's now in Bulgaria, visiting her family over there, and I'm going to be a single dad for 3 weeks. Single parent. I'm actually looking forward to it.
Don't tell Anna you said that.
It's pretty crazy. I have to do a lot of proper scheduling, but we've got a lot planned. So and of course, after having a very slow summer season in real estate, pretty much 2 days prior to Anna leaving, all of a sudden, very busy.
Yeah.
Week full of appointments. And but that's the nature of the beast. I expected that, and I'm looking forward to it. So it's laser focus time.
Someone once told me, if you're a realtor or mortgage agent, you want to get busy, just go on a vacation, because that's usually when the phone starts ringing and you got to sit by the computer.
Or if you're working in a team, have them go away, and then, you will be busy handling all of their business.
That's okay. Just send your whole team constantly on vacations so you can build business. That might be an interesting lead funnel.
That's it. David was there. David's back. David, how was your weekend?
Weekend was good. Sorry, my internet is crappy right now, so I might be in and out regularly. Weekend was good. I ended up coming up to the cottage last night, so kind of an impromptu.
Impromptu paradise?
No complaints other than this internet connection. But
okay. I like it.
What can you do?
No, never any technical problems on tow wrap, right?
No. We're amazing. Just like the Ottawa real estate market, we never have any blips. No issues.
Everything's just smooth and perfect.
Everything's rosy.
Yeah. We were talking. My weekend was fine, by the way. We were talking. Actually, before we get into it, we were talking to DC about golfing, so I'm just gonna shamelessly plug the Boys and Girls Club annual golf tournament this Friday. We have 2 spots left for teams. It sold out last year, so it's always a good show. We're playing at Cedar Hill this year on Friday. So if you're interested in a foursome in there or even a single, we basically got 2 teams left. So just shoot me a message. Send me an email. Emails are in the comments. And support a great cause. Play around a golf. Come see me, chat. Talk real estate. Gentlemen, okay. That's what we're here to do. Let's talk real estate. Darren Campbell. Let's bring DC in. Darren, you're here now.
Hey, guys.
Welcome. Hey.
Thanks for having me.
Yes, welcome. The Campbells. We can't get away
from the Campbells. Are here.
Everywhere
Greg
we turn,
and I are
Campbells.
overtaking this. Greg and I are overtaking this. Good Scotsmen that we are.
That's
Darren, maybe give all of our listeners maybe just a quick bio, kind of your background, how you got into the industry and what you're doing now.
Yes, thanks, Paul. So I'm an East Coast boy. I grew up in Cape Breton, Nova Scotia. Born and raised there, and went to school, university at St. Mary's in Halifax. Graduated there with a BCom in 1999, and started right in the finance game. I started with a company called Household Finance, HFC, for those that are old enough to remember that. And that's basically high interest loan lending back in the day, lending sales contracts for people who wanted to buy TVs and couches and all of that stuff. And then, it would turn into consolidation loans and things like that. So that's where I got my start. It was a great training ground. And then kind of worked my way up through there and became a branch manager out in Thunder Bay, Ontario. So they moved me out to Northern Ontario, which was a bit scary, but I lived out there for a little while. And we used to do our banking at the Royal Bank. So I kept going in to do the daily deposits at the end of the day. And one of the guys there said, "Hey, like, you should become a mortgage specialist with the Royal Bank. I think you'd be great at it." Yada, yada, yada. I decided to make the move over to the bank and became a mortgage specialist and did that up in Thunder Bay for 3 years, and then moved. I was, in the middle of nowhere, had no family connections up there. So I moved down. I requested a transfer and they were great. They were kind enough to pay for my move down to Ottawa in 2006. And I moved here in 2006 and worked another 7.5 years in the Ottawa market as a mortgage specialist with the Royal Bank. And then there was an opening in the broker side with a lender called MCAP, which I'm sure you guys all know well, and a lot of your listeners may know as well. And so I became a business development manager with MCAP right around the time when B20 came in 2012, that time frame. And I made the move over because Royal Bank at that time weren't really paying their reps on refinances and things like that. So it just became a little bit more arduous for somebody who had been in the business for a little while. So I ended up moving over on the broker sales side and became a BDM with MCAP and was there for 7 years with the mortgage finance company, and then decided to try my hand in the private space and moved over to Magenta for a cup of coffee. And now I'm with a great lender called Westboro Mortgage Investments Corp. And we are, doing private lending here in the Ottawa market and Southwestern Ontario, as well as GTA.
Yeah, thanks, GC. That's
the background of Westboro itself, like kind of what Westboro does, you focus on, all that. I mean, that was quite the in-depth background of Darren Campbell, that's for sure.
Yeah, I was gonna say that's the show, everyone. Thanks, Darren, for coming out.
You guys know
we missed your blood type. That's all.
So Westboro is a lender, a private lender that started in 2004. So we're basically entering our 20th year. We've been, our niche is construction. So the number one thing that we do here in Ottawa is our construction mortgages. So it's an area of the market that's, not a lot of people do it well, and it's not an easy part of our business. So, those that have built homes before and those that are thinking about building, the banks will do it, but they don't quite do it as flexible as people think. So, when you're dealing with Westboro, I think we pride ourselves on the fact that it's very flexible. It's a very flexible product. You get your money on time. You get usually more money than the banks are willing to offer. And, you get it quicker. It costs a little bit more, yes, but I mean, it makes up for it in the flexibility. So that's probably our niche product. We do residential first mortgages, we do second mortgages, we do bridge loans. We help people when they're in a jam in terms of kind of life unexpectancies. So, divorce, job loss, changing careers, that sort of thing, where they can't qualify, with a bank or a prime lender. We can kind of come in and step in and kind of take over and, really kind of help bridge the gap for that person to be able to kind of get them over the hump of whatever life thing they're going through at that time, and then get them back onto a prime lender.
Yeah, right. We had a circumstance recently that we were chatting about, just to give everyone an example, where client had really good job, well-paying job, 6 figures, excuse me, and lost their job in January, but already had a new purchase agreement for a new build. And we were kind of talking about those as an example of what you mean, like life circumstances change, and the traditional banks, Schedule A, Triple A, the TDs, the Scotias, the RBCs of the world. They're much more conservative in their requirements and so on, right? And less, I would say, common sense lending. Now, for anyone who isn't aware of, so Westboro is considered, I guess, like a MIC on the private side of things, where people can actually contribute money to Westboro, right? And then you guys lend it out on their behalf. So maybe just explain to everyone, like, what does that mean, and how do people kind of get involved with you in the first place?
So private lending, I guess, is a very kind of loosey-goosey neighborhood, I will say. Like, in terms of, you can have three different types of private lenders. You can have, Paul, you have an extra $1 million and you want to lend it out to somebody privately to help finance a purchase or whatever, and that person will pay you their mortgage payments and you will make interest off those payments. That is one, that is kind of your basic typical private lending. But there's another type, and that's your mortgage investment corp, which was what we are. We collect and pool a bunch of private investment funds, and that could be, from exempt market dealers, as well as like IIROC approved investors. So you have to have a minimum criteria to become an IIROC approved investor. And, we also go to wealth managers and things like that. And they kind of put their clients or part of their portfolio within our company. And so what we do is we pool those funds and we kind of merge them with bank lines and things like that to kind of reduce the cost of funds. And we then lend that money out and provide a return for our investors. So that is basically what we are. We're a mortgage investment corp. Yeah.
And how much do you guys have under management right now? 400?
Yeah, it's a good question. So we are about 380 million in assets under management or mortgages under management at this time. We have the ability to probably go to like 450 at this time with the current amount of investment that we have. So we have lots of money to lend. We're currently actively trying to deploy this capital that we have in the market that we're in right now, because it's, private lending is up 35% year over year right now. And as you guys all know, that's, the bank's boxes are getting tighter and smaller, and it's not easy to go to when rates are at 6 and 7% to qualify at 8 and 9% for a mortgage at the bank. So, we don't stress test, we don't debt service, so we're kind of able to get clients into the market quicker. And then, as I said, like, they can kind of get themselves some foundation under them in terms of their financial stability, and then we can kind of move them off into typical bank or prime lending, So yeah, to answer your question, short answer is we're about 380 million in assets under management, and we've got a long runway to go to about 450.
That was a great comment that you made, that I don't think a lot of people understand the comment about the stress test at the bank, and with a private lender, you don't necessarily need that. Just as long as you have everything else in order, I suppose, and just as long as the file looks decent.
Yeah. So, I mean, we look at it, I guess Paul made a comment earlier today about common sense lending, and that's what we are. We look at the situation and we go, is this person going to pay us? Number one. And are we making their situation better? Like, can we see the ability for them to get back on track and get, with an A lender or a prime lender? And if the answer is yes to both of those, then generally we've got a deal. We don't lend, we're not a CMHC approved lender or anything like that. So we don't lend to like 95% loan to values or anything like that. But generally speaking, the people that we help have cash. I think that's a common myth about private lending is, people that go to private lenders have no cash. That's not necessarily the case. They have a lot of kind of liquid asset or capital that at their disposal. They just can't prove their income a lot of times. They can't service their debt on paper. And, a lot of them are self-employed. Like, I would say our average Beacon score is well above 700. And our clients are I would say for the most part, self-employed individuals that, they'd rather pay 8, 9, 10% interest than pay 50% tax, right? So, I mean, the trade-off with that is, yeah, people go, oh my gosh, your interest rate, it's way higher. But if they have a smart accountant, this is the way to go in a lot of cases, right? So, it's the myth is, oh, you went to a private lender, you must have bad credit, or you must have no money, or you're hurting in some way or form. But the truth is, a lot of them are very successful entrepreneurs and just don't declare the income that they actually make.
And strategic, right? Like they might be working with you strategically to get to point B, right? Or as you said, like you're kind of looking to find a solution for someone short term to get them into a better position. I think there's kind of a common misconception about private lending that it's maybe more predatory than people think. Like everyone, they're just trying to get their interest and their fees, and then they don't care about the client. But I feel like from the experience I've had, and I'm sure Dave, you can say this too, the ones that we work with, and at least on the broker network, are not of that nature, right? I mean, there might be some, like you said, those mom and paws that are actually looking to be predatory, but that's very uncommon, at least in our space, for, mix and actual, proper private lenders that we work with in our network.
I agree. Yeah.
So changing gears a bit, Darren, we were talking about, or we have been talking about for the last year, probably, the lack of supply in the market. So as a lender who focuses primarily on construction, like what have you been seeing over the last, say, 6 to 12 months on that side of it? Like, have you seen starts slow? Have you seen people not be able to get financing? Like, what's happening? What are you seeing?
Our construction, so a couple of things on construction. Normally what we focus on is kind of your infill type of builder, your smaller builders that do, maybe they're non-Terrion builders or whatever, that kind of do a lot of, like, let's say less than 10 builds a year, within Ottawa. So, we do a lot of work with them, and we've noticed this year that market has slowed. The margins just aren't there, to kind of buy the lots and build at this time. So there was still a good spring market, and it kind of went through the summer, but generally speaking now it's kind of slowing down a little bit with the construction market, right? As we move into the fall and into the winter, people don't undertake a new construction usually around this time. It's generally around the spring, where they have all summer to kind of get going. What we do see at this point is the people that come to us now generally have the house, airtight, framed, roofs on, windows and doors are in, and they need the money to kind of work through the interior and stuff. So, which they can do that through the winter time, but they're not starting their construction usually in kind of August, September timeframe. So, yeah, I mean, it's slowed for sure. And I think there's a lot of money kind of hanging around in the sidelines right now. People are waiting to see what happens with the Bank of Canada and go, you know what, on this first rate drop, I think you're going to see people go, okay, the end is now. We can finally focus on maybe moving forward in this new state that we're in with higher rates. But I think people right now generally are nervous about starting any type of new construction or project with, rates sitting at 6.5% to 7%, right? It's just, it's not maybe the time right now. And I think they want a little security, especially in Ottawa. Like, we're a conservative town. People don't generally undertake a lot of risk in this market. So I think, as soon as we see that first rate drop, I think we're going to start to see the floodgates open a little bit.
And to that point, Darren, what I know you guys aren't a prime lender, and what you do isn't based off of what the Bank of Canada is doing or anything like that, but what are you, obviously that still plays into it, like you're saying, of kind of those floodgates being opened as far as demand for even your services from a lending perspective. But what are you guys seeing or anticipating from spring or fall market and kind of for the rest of the year? Internally, have you guys had discussions around what you think rates are going to do, or what the Ottawa market is going to be like on a
this year basis? Has been different. I think this year, we've been so lucky with the last couple of years during COVID, where it was kind of like there was no spring market. It was just full on all the way through the year. And a lot of us in the business, like, lenders, agents, real estate agents, brokers, we've all reaped the rewards of that. This year was a little bit more traditional, back to say like 2018, 2017, like where we've actually had some fluctuations during the year where there was maybe an actual spring market again, where, activity peaked and we saw some
Girls, I hope you're not watching a show.
We saw the numbers go up in that time frame. And then, now in the fall, I think we're going to see a little bit of a spike once we kind of get through the end of, maybe through the first couple of weeks of school going back and stuff. We might see a little bit of a bump again in that end of September, October timeframe. That's what we're predicting anyway. So, again, the private space has been pretty steady throughout the whole summer and the whole year so far. But yeah, we're expecting a little bit of more of a bump, especially if kind of rates level off and drop a little bit.
That's what we've been. Sounds like you've been listening to the podcast we've been saying as well.
Yeah, well, you're not wrong.
Did I just say that out loud?
Yeah, exactly. Well, you guys know what you're talking about. You're in the business. It's for the average consumer out there. Like, they may not know that, but I think, like I said earlier, there's a lot of money sitting on the sidelines right now, and people are still getting divorced. People are still dying. People are still getting married. People are still changing jobs. The need for houses is still there, right? So, transactions aren't going to stop. And whether the rates are up or they're down, people still have needs for housing in this country. So, obviously, I think just people are kind of waiting around right now to see what the next move is by the Bank of Canada. And I think you're going to see, as soon as they decide either to drop by a quarter point or maybe even stay the same, I think people are going to get a little bit more comfort level. And I think you'll see that things, all that money on the sidelines is going to flood into the market.
Well, I think we're all hoping that the announcement in September is just kind of the same. It doesn't move, because if it goes up anymore, it's going to turn to a buyer's market pretty fast, in terms of people still needing to sell and buyers hesitating and having their pick. I'm already starting to see it in the market. There's a lot coming out. Buyers are taking their time and got a lot of properties to show now, and it's good for any new buyers that are just fresh in the game.
Yeah.
Yeah, Dave, I don't know about you, but like, I've just been seeing, like, from a pre-approval standpoint, like, kind of my lead tool, or my client management tool has, leads, active files, closed, etc. And the leads just keeps growing and growing, in a sense of a lot of people pre-approved, kind of waiting, as you said, Darren, like, even people waiting to buy, like, everyone's just kind of waiting. Everyone's at that starting line, kind of waiting to see what happens. And I mean, we've said the same thing. I think if there's any little ounce of positive news and people feel there's some sort of consistency or some sort of balance, then I think they'll feel more confident going into the market. But there's still a lot of people that it's just been negative headlines for a year straight, so I think people are very hesitant to take that first step.
And I think too, Paul, like, there's a dichotomy with the Bank of Canada that, every time they raise rates, they're trying to do something which is obviously curb inflation and drop inflation down. But every time they raise rates, they're raising housing costs. And that, of course, increases inflation. So that's the issue that we're fighting, right? So, and I think they've reached that breaking point. And that's just my opinion. Obviously, I'm not an economist or anything like that, but I feel like it's almost counterintuitive to go any higher at this point. But hey, as I said, I'm not an economist. I don't know their thought process on it all, but I do see that they're not achieving the desired results with these rate hikes, right? And that's the biggest thing. So there's got to be a better way or a different way to go about curbing inflation. And I don't know about you guys, but have you been to a restaurant lately, or have you been to the movies, or have you been anywhere? People aren't stopping spending.
It's crazy when I see the bills that I pay now when I go out with my family and look around the restaurant, like you said, and I'm like, everybody's just spending money.
Yeah.
You know? Where's it all coming from? Everyone's complaining about housing, but everyone's still out, buying groceries, entertainment. Like, people like to go do stuff.
It's debt level. It's all the consumer. It's all the unsecured debt level. Like, you saw it pay down to, I think it went from, during COVID, from 90 billion down to 70 billion of unsecured debt, and now it's back up over what it was pre-COVID. I think people just got used to, they're depleting their savings and then ramping up their unsecured. Which
sounds like Dave's suggestion we lock ourselves in our homes. That's what Dave. Is that what he just said? I'm fearful of, from a Bank of Canada standpoint. Like, my fear now is that everyone's so critical and everyone's eyes are so much on Bank of Canada and the policies and decisions and of the government and so on, that I fear that there's almost like this, and obviously you hope that there's no ego involved in these sorts of massive decisions, but I fear that they won't lower rates for fear of being criticized for raising it so much in the first place. Like, that fear of criticism, I think, will make them, well, at least weigh into their decision. Like, well, we don't want to lower it now because then it looks like we made a mistake last time. So let's actually just either increase it or keep it the same just to save face. Do you think there's any of that involved in these decisions? I would hope there isn't. But at the end of the day, it's still humans making these choices, and they run on emotions at times. So
yeah, I agree. You're not, I don't think you're wrong in that. And hence the reason, like, I think maybe them staying constant on the next one, we'll see what happens. That might be a preempt for that. The following one, maybe they drop it a quarter point or something. But the plan was always, at the end of this year, beginning of next year, to start the easing process, right? So we'll see what happens. It's going to be an interesting next 6 months to 12 months. I think will be very telling. And you got to remember too, like, we haven't really touched on this, but people that are in 5-year mortgages at 2.5%, those guys are all coming due in the next 18 to 24 months. That's when the pain is going to be felt. Like, myself personally, I'm in a mortgage is 2.75. Our renewal comes up next July. So, that's going to be a massive payment hike for our household. So there are a lot of people that are in that world. People that are in variable, they've kind of felt it in death by 1,000 cuts. You know what I mean?
Yeah.
People that are in a 5-year fixed mortgage that they got in, 2019 or 2018 or whatever, they are going to really feel some pain next year and the year after. So that is when we're going to really see kind of what happens at that point. Like, where are rates going to be, and how bad is the carnage? That's what we're going to find out.
There's a number of economists that were saying that and I think Benjamin Tal was one of them, but saying that the static variable payments from, like, the TDs and I think RBCs are saving the economy. That if it wasn't for those static variable payments, that really the pain would be truly felt, because those people haven't actually felt the impact. They've gotten letters of a trigger rate, but they're going in reverse amortization. They haven't changed their payments, or they're having to increase it slightly, but they're not actually really feeling it. And there's a lot of kind of talk out there that those are going to go away, that OSFI is going to make a change to not allow those static payments anymore on a go-forward basis, which is interesting because those of us, myself included, a Scotia, or anyone in an adjustable rate mortgage, so where Bank of Canada makes a change, payments go up and fluctuate accordingly. We've felt it, of that 80% increase basically over the last year and a half, but a big shift of the market, or a big portion of the market, hasn't actually, to your point, Darren, hasn't felt it for those static payments or the fixed, or anyone in a fixed mortgage that, as they come due, are really going to kind of
Well, but even those, Dave, like those mortgages, eventually they're going to feel the pain, right? Like they have to. Like, a lot of them are still 5-year terms. So, I mean, at some point, the bank isn't just going to say, "Oh yeah, it's okay with you having a 50 or 60-year amortization." Like, we're not okay with that. You know what I mean? So eventually, those people will also feel pain, I think, with the static payments. So whether it's through OSFI changing the rule, or whether it's the renewal comes up and, the bank says, sorry, we're not allowing that at this time, or we're going to move you into some different product. Like, eventually everyone is going to feel this at some point. Some have already felt it and some have not already felt it, but it is going to filter its way through the market for sure.
And on that rate topic too, because we were talking earlier about private lending, and you were saying there's a misconception of people with kind of bruised credit, that they're the only ones using private lending. And in the past, it's been such a wide spread of rates as well between your traditional and your private lending, but now there's not as much of a delta anymore. There's not much of a spread, right? I think most of your rates are in the 9s, but a TD and Scotia are in the 6s, and there's not as big a spread anymore. So are you seeing, because of that spread narrowing, are you seeing a lot more people that are like, well, it's interest only payments, or a 40-year amortization? They're like, well, hell, for the couple extra percent, I can just go there and actually shave off on my budget.
Yeah, I mean, in some cases, because we have a 40-year am, like, our payments are actually less, you know what I mean, than a traditional bank lender that's at 20 or 25-year am. So, we are seeing that. I would say, like, there's a lot of things that we're seeing. Is the biggest common thing I've seen over the past, say, 6 to 12 months is client bought a new house. Maybe it was a new build, expected they would sell their house, didn't list it until 60, 90 days before, and the house isn't selling. It's sitting on the market. And now they're panicked and they're like, what do we do? We have 2 houses. We can't afford 2 houses. We have to close on this new one, or else we're going to get sued. What do we do? Right. So we're coming in kind of a lot of those situations, oftentimes at the 11th hour, to save them from, getting sued, and trying to come up with a creative way that they can just kind of hang on until this house sells, basically. Right. So that's, and, as Greg will tell you, everything sells at the right price. So, sometimes they have to lower the price or whatever it may be. But, we're doing what's called a blanket mortgage. We'll do we'll tag the property that's listed for sale, as well as tag the new purchase. Maybe we'll cap the interest on the mortgage so that they don't have to make payments on the place that they're listing for sale. So it's just a short-term solution. Maybe we'll do interest only, or whatever, 40-year am, whatever it makes to make this little blip kind of thing in their life a little easier, and that we can kind of help them along in this process until that property sells, and they're back in the game on the prime space, or whatever it may be.
I think that's a good explanation as well, Darren, as to why it's so important to work with a broker as well, or a mortgage agent, because someone walks into their RBC or TD or wherever and explains that story you just said, they're going to be kind of SOL. We don't have a solution for you, and they kind of send them out the door, right? There's not really we can look at this, we could put a blanket on here, we could do that. Like that doesn't exist in that space. So that's why it is very important, if anyone's listening and if you know someone that's kind of in these situations, or they have a closing coming up, or there's something wonky that makes sense but can't get done elsewhere, like, certainly give Dave and I a call. We can kind of walk you through the different steps. I wanted to go back quickly to what you were saying about the renewals. I just hope in those cases, like you were talking about, I think I was listening to another agent out west that was talking about numbers. I think there was like over 300 billion per year in the next 2 years coming up for renewal. And I just hope that those people have been properly educated, especially the ones that are in those variable rates, that their payments haven't changed. Because, I have talked to people that were new clients to me, but that came and didn't have any understanding of what their variable rate meant. Like, our payments haven't gone up. And that's where it ended. Like, they didn't, like, it didn't impact us. Like, they don't understand. Yeah, like, they don't understand that there's a wave coming that they're going to feel in maybe 2 years or 3 years. They just assume, nothing's changed. Our payment hasn't changed, but their amortization is growing. So I just hope that those people that are coming up for renewal properly understand the product they're in, and are getting properly advised, because it is going to be a wake-up call, I think, for some people.
My prediction is they likely have not, and they're the people also at the restaurant sitting beside you, continuously out at the restaurant on a regular basis. So,
yeah, that's actually what made me think of
again,
it. Was
ignorance
exactly
is bliss.
That point.
Yeah. Just kind of when you were talking, Paul, it made me think of something too. Like when you're talking about renewals, like private lenders aren't all the same either, right? There's some private lenders out there that, they're not quite, they're in it for the buck, obviously. Not that, I mean, we're a business, everybody wants to make money, but it's important if you're putting a client with a private lender that you trust them and that private lender. Like not all private lenders renew their clients. If a private lender is in like a syndicate type of a mortgage where it's like there's some lenders out there that will find a specific individual that will fund this person's mortgage, and that specific individual wants their money back, and maybe the client is like stuck and they don't have anything, like, you got to be careful, because private lending is largely unregulated. I would say, like, obviously MICs are regulated. We get more audits than the banks, I feel. So it's just important that you're doing the right thing for your client. Like if you put your client in a private lender, you need to counsel them to say, okay, look, you're going to be here for a year, potentially 2 years. This is our plan to get you back, with a bank or with a prime lender. And, we've got to follow this plan, because again, we're constantly money in motion, right? Like we want to deploy capital, but we don't want to be renewing clients year over year over year, because that's not our purpose. We're there for the short term, and we want to make sure that we will definitely renew your clients. That is not a question at all. But we want to, at some point, financially, it doesn't make sense for your client to stay with a private lender for a long term. It just doesn't. They're paying too high of interest. They're paying too much on renewal fees. It does not make sense. So you have to have a path to get them, out or back with a prime or an alternative lender, because it's that's and a lot of people, I've seen this so many times where there's some lenders that are maybe they're having some liquidity issues and they're a little bit tighter in terms of what they need more money back in, and so they're not renewing their clients, or they're forcing their clients to get really ridiculously high renewal rates, and clients don't have options, so they're paying it. Like, to me, it's criminal. Like, like when just an example, I saw a renewal where a client a year and a half ago had I think it was like 479 or 499 or something, and now they're at 1499. Less than 2 years later. So that is, you got to be careful with who you're placing your clients in a private with.
For sure. I think we should revisit this in about 6 months.
Yeah, I agree.
We'd have DC on again. Be a nice little update.
I'd love to. Yeah. It's going to be it's going to be an interesting time period for sure.
Yeah, I think kind of we talked about it last week too. I think taking like some of the stuff from like, what we're thinking it's going to be in this fall market, and kind of just fast forwarding and kind of just earmarking it, seeing, by December what transpires, because really a lot of it, and Darren, you touched on it earlier, is like if the Bank of Canada holds steady in September, again, and every time we've seen it of the bank holding steady on rate increases, more confidence has been kind of pushed into the market. We've seen kind of an uptick in activity. So it'll be interesting to see if coming back after Labor Day is always a busier time anyways. Kids back in school, parents start, looking at new homes because they have that extra time on their hands, if you will. Yeah. And then combining that with that announcement, I think it's September 12th. It'll be interesting to see if it does hold steady and that typical activity, like increase in activity, kind of how that transpires, and through the rest of the year. But I think it's going to be a more interesting time than, we've seen since, like you said, 2017, 2018, kind of that typical, ebb and flow market. We're kind of, I think everyone's on edge, like not knowing. Yeah. I think
there's
we're all
no
like
slowdown in the private space. That's for sure. I mean, it's constantly, we're seeing different things. Deals are getting a little bit more tighter, hairier, Yeah. And, definitely the applications are still flowing through, at mock speed. So I think, it's really like, I think when the rates go up, it makes us busier just because less people are qualifying, at prime lenders. So we'll see what happens, and maybe if a rate drops and what that does to the private space, and see where things lie.
Yeah.
But we pivot, like every lender and agent and broker, we pivot. And, I'm sure, for the remainder of 2023 and into 2024, we're going to have another record year. So.
Yeah, we'll bring DC on back early in 2024. It's like 6 months time just to see where we sit in the winter.
End of Feb. See where we're
Love
at.
it.
Yeah, man.
Right before the spring market.
Yeah.
Yes.
Well, should we, Paul, should we slide into some mood boosts?
Yeah. So DC, probably if you haven't watched a full show, you probably don't know about the mood boost, but we end each show with a couple jokes, a little lighter, just to give everyone a little boost on the way out of the listening studio. So I got 3 today. Number 1, I've been banned from the secret cooking society. I kept spilling the beans. We don't, Steven. Usually there's a nice drum roll here.
There's no drum roll today.
Number 2. Oh my gosh. Number 2. I turned down a job where I would be paid in vegetables. The celery was unacceptable. Didn't like the celery. Number 3, last but not least, I was addicted to hokey pokey, but I turned myself around, gentlemen.
Oh, yes.
Oh, wow.
Yes, that's my favorite.
Thanks for tuning in, everyone. Thanks to DC, Mr. Darren Campbell from Westboro MIC, who graciously blessed us with his presence today and his knowledge, his experience. Thanks, everyone, for listening. We're back regularly now. Shows are out Tuesdays. We had the live show last week. If you haven't checked it out, go over to our YouTube channel. Or onto any streaming platform. Check out the live show from last week. Some really good questions. We had one really active listener. And we'll be back next week. Have a good week, everyone. See you soon.
Thanks, guys.
Yeah.
Cheers.
Okay.
Thanks for tuning in, everyone. We hope you enjoyed today's episode. Please remember to like, share, comment, and subscribe, because we'd really like that.